Nashville had a massive amount of supply, and we're starting to see that supply eaten up and not having as much supply coming to the market with jobs still growing, which will eventually heal this market and put pressure back on rent. Welcome everybody to another episode of Keeping It Real Estate. I'm your co-host Dan Brisse. Today we're going to talk about submarket demand and how we're choosing submarkets, why we're choosing submarkets to get ahead of the supply-demand imbalance that we see coming. As most of you know, what controls rent is very simple, and what controls any market is supply and demand. Our goal is to find an asset that is being undermanaged, under cared for, really has some deferred maintenance that has not been taken care of, that we can come in and resolve, along with not enough supply and excess demand, meaning more people looking for places to live than are available on the market. So, let's start with DFW, Dallas Fort Worth. A lot of our assets are Garland, far north Dallas, and we're going to dig in a little bit to the different metro levels here. So DFW, first of all, the employment is growing. And according to the Federal Reserve Bank of Dallas data, employment in the DFW metro rose 46,800 jobs over the year in May of 2025. Unemployment is very low. Garland, for unemployment rate, is about 3.8% as of the latest available data that we've been reviewing. And these fundamentals point to demand for housing, especially rentals, because job growth generates households. Again, as jobs come in, as people come in, they create households, and it puts pressure on what is available to rent in the submarket. Household median income for us, for Garland, has a median household income right around $63,192. It's well above the Texas median average of about $54,000. Employment base in Garland is stable and growing. Best Places reports a job growth rate of 32%. Maybe overextended a touch for a short period, which is still above the national average, but labor force size is around 134,000 people. That's as of June of 2025. And then Garland sits in what, the 2022 Bradford North/Northeast Dallas development site summary is called an inner ring suburb, which is located east of the northern path of demographic and employment growth in Dallas. Really just means formerly more established. It's positioned to benefit from growth filtering outward from the higher tier suburbs and may have lower supply competition than, say, a premium submarket. As far as far north Dallas or the broader DFW region continues to add jobs and population, and it just filters into leveraged submarkets like far north Dallas, offers affordability relative to core Dallas, but also still proximity to major employers, different amenities, and transportation. And additionally, Garland and the north quarter of Dallas benefit from infrastructure logistics. You've got industrial growth, data centers, distribution, which adds to employment beyond the white collar tech, finance jobs. This is a diversity, and it's very positive for us. Some ways that we at Granite Towers are going to be tracking, and we're going to communicate this submarket for multifamily, is we're going to monitor employment growth by zip code or submarket. So for example, you might have a new job announcement in Garland or far north Dallas, whether it's corporations, relocations, expansions, and we just correlate that household formation rate as new renters forming households. And then we're going to compare that to the multifamily supply pipeline in these submarkets, and we're going to see how many new units are under construction or are planned, and is the supply growth modest relative to the population household growth. And if we've got supply that's small relative to the demand, that's a sweet spot. That's getting ahead of what's coming. So if you can get the data of where the folks are moving versus how many jobs versus the new builds, you can get an idea of what the supply demand is going to be in the coming years. We're going to evaluate rent to income cover ratios in the submarket. With Garland's median household income above Texas averages, a rent to income ratio may look favorable for healthy rent growth. And we discuss migration/inflow patterns. They're just people people moving from higher cost metros, maybe a coastal state, into these submarkets like Dallas, Fort Worth because of affordability or different job opportunity. And basically that puts constraints on the supply. So we highlight supply constraints. For example, older inventory in Garland plus limited new product may create stability and vacancy and opportunity for value add repositioning. All of this has to be taken into consideration when you're looking at investing in a submarket, because this is going to dictate the future of what you can do with rent and how to drive net operating income, because that's really the goal we're all looking to create here, is how do we increase rent, control our expenses, and provide value for the investors that own these deals with us. And that really comes down to taking care of the residents, you guys, too. I don't think it's talked about enough that as long as we take care of the residents on site and we provide great product, great customer service, safe, clean housing, the rest will take care of itself as long as you've got the supply demand imbalance. Specifically looking at Garland, far north Dallas, some of these other areas, McKinney, Plano, you've got twofold tailwinds. One is you've got solid employment base and growing wage base. And then two, relative value versus core Dallas, meaning renters who might have paid premium in Plano or Frisco, they're migrating to these more affordable, higher amenity submarkets. And by drilling into the submarket at a zip code or a census tract level, we at Granite Towers, we can identify where the new jobs are being added and then track how much multifamily product is already under construction. Like, for example, in Garland, we're seeing a job strength plus controlled supply, which gives us confidence in achieving above market rent growth in the future. Some of the submarkets north of Dallas that we're looking at, they're particularly attractive because it benefits from both inner ring accessibility. So you've got connectivity to major employer nodes, and you got northern growth corridors, which often offer just better affordability. And we aim to be in these areas before the general market pricing ever catches up with us. And then we share with our investors that we're not simply buying in Dallas generically. We're buying in very specific submarkets where the fundamentals, where it's jobs plus population plus supply/demand imbalance align favorably. That is a market where you have a better chance of driving net operating income purely because you've got tailwind with supply and demand. I love the simplicity of supply and demand. How many new builds, how much new product, how much vacancy do you have on the market versus population growth? Some things to watch out for just to show some discipline in investing. Even in a strong metro like DFW, submarkets can oversupply. And we've saw that since 21 and 22. There was a massive amount of building happening, and you've got oversupply that really has been going throughout the whole country. And some markets have been affected much more drastically than others. We're going to monitor multifamily permits and new completions flagged in industrial office nodes that may create future competition for rentals. For example, you've got a sale for housing starts flooding the market, that could change what's going to happen with the rental market. And then wages have got to support rents. So we check that the newly created jobs in the submarket are sufficiently high income to bear our targeted rents. Not only low wage service jobs. You've got to have residents who can handle the rent. If they can't handle the rent, you're never going to be able to keep the NOI in a growth phase. And then you got to also keep in mind that migration momentum must continue. So a submarket can look strong today, but if inbound migration slows or reverses, demand may flatten. Another market, as most of you know, we're looking at is Greater Nashville. Why Nashville matters. According to the Greater Nashville Realtors report, job growth and population expansion and sustained housing demand continue to position the region for long-term success. And in 2024, the region added over 32,000 jobs, which was nearly 3% growth. Multifamily market data, Q4 of 2024 report shows 11,811 units absorbed over the past year, and asking rents rose to $1,596 from $1,529 1 year prior. Again, most of you know this. Nashville had a massive amount of supply, and we're starting to see that supply eaten up and not having as much supply coming to the market, with jobs still growing, which will eventually heal this market and put pressure back on rent. And why this matters for our strategy here at Granite Towers, Nashville's jobs and population growth are creating rental demand across both urban and submarkets. So for example, the 35 to 44 age cohort is the fastest expanding renter demographic in the metro area. And then supply pipelines are now moderating. So forecasts, this is incredibly important. Forecasts indicate that new multifamily deliveries will decline by about 41% compared to the previous years. All of that signals to a potential shift from heavy supply build to absorption catching up, which is exactly the moment seasoned investors are going to want to act. And that time is now. And you guys, I want to talk a little bit about the last several years. I hear so many investors that say, hey, I'm not investing in multifamily anymore. I invested in a deal in 2021 or 2022 and it hasn't done well. And I just want to share what we've seen. And you got to understand, take a step back for a second, that every asset goes through a cycle. And that's never changed for the last 250 years. There's been a real estate cycle here in the US, and that's not going to change moving forward. You look at deals that were purchased from 2012 to 2021, anything that you bought in that time and exited, most likely in a solid market with a decent operator, you made pretty good money on your returns. And it was a nice decade of inflationary rent, prices going up, rates coming down, cap rates being compressed, too much cash in the market looking for a home. And it all peaked in early 2022, right when the Fed started to raise rents. And so, at that time you're buying deals, and I'm just sharing a stat, nothing more than data. We bought a deal in 2019 and exited in 21 and had ridiculously large returns that are not normal for real estate. And that was a unique moment in time. Nothing more, nothing less. And we get calls from our investors, you're my hero. Where have you been my whole life? How are you guys doing it? Yada, yada, yada. And then, as most folks know, in 2022, interest rates started to rise as they were looking to tackle inflation, the Fed. And as interest rates rose, they started to have cap rates follow. And when cap rates go up, values come down. And at that time, everyone and their mother that had been doing so well in multifamily for 10, 12 years, inhibition was thrown to the wind. It was bridge debt, variable debt, pay whatever's needed because in a year you're going to double your money, and the music stopped. And so a lot of the pain that investors are feeling today are from 3-4 years ago. And now we're seeing pricing resetting. We're seeing interest rates potentially coming down. We're seeing cap rates potentially following interest rates. We're seeing expenses that have been high and are high. We're seeing rent that is low. So this is a great storm for buying what we think may be some of the best deals we've seen since 2009, 10, 11. And it would make sense based on the real estate cycle. And now, can I say we're at the bottom? No, I can't say we're at the bottom. Is it likely that we've gone through the majority of the pain based on what we're seeing with the jobs reports today? Yeah, it is. Based on what they're saying, it's likely that rates are going to be coming down because the job market is softening. Does that mean in 12 months, everything's healed? No, I'm not saying that either. But what I'm saying is that cap rates so much can affect the value of these buildings, and it generally follows interest rates. So let's just assume that we continue to see similar data based off of what we've seen from the Fed over the last 6 months. And I think they're behind in times based on what I'm seeing real time from our residents. I think the market and the economy is worse off than they realize or than they're sharing. And we may see some pain in the market. And obviously rates coming down is good for real estate investors, but it shows there's pain in the market. That's the only reason they're lowering rates, is to stimulate the economy again. Inflation is low or under control enough where they now are like, hey, there's a bigger problem here, and that is jobs. And when people start losing jobs, now the Fed has to prioritize, how do we get jobs back up? And the only way, the lever they have is to bring rates down, which will create building, which will create more home purchases, which will create more movement in the economy, more money flowing. It'll unlock the flow of capital. And so that's where, if you can see all of that now, so much safer to be investing today than it was back in 21 and 22. And so interesting. I've said it on the podcast before. I'm just going to say it again. Warren Buffett, he said, when others are fearful, be greedy. And when others are greedy, be fearful. And I've had such a front row seat to seeing that. Back in 21 and 22, it was loaded with greed. 2020, 21, 22, pure greed. Buy inhibitions to the wind, let's go. And now here you are in 2025, heading into 2026, and fear is high. And most folks that were buying, A, they're not buying, or B, they're gone. It's shifted so much. And so it's such a clear example of Warren Buffett's line. When others are fearful, be greedy. And I think it's those folks that have been through market cycles. I was just on a call this morning with some extremely high net worth investors who've been doing this for 30 plus years, and they're about to have a large exit, and they can see the writing on the wall that this is the time to be back buying deals. And so I just want to encourage you to take a step back and put your emotion to the side and just look at the data. And the data will set you free. The data will give you the confidence. I have a group that I'm a part of, and I saw in their text message, I just wish I had the confidence to be showing deals to my investors. In my mind was, get to the data. Because as soon as you start looking at the data of where we are today and where the market cycle has been over the last decade and where we're likely headed, it seems to me all indications show this should be the most exciting time, the most aggressive time to be buying great deals. Keep your criteria straight, get your debt straight, get your exit strategy straight, get your market straight, which is what we're talking about here, and buy great assets and get a good 5, 7, 10-year hold. Thanks you guys for listening. If there's anything you want us to speak on, please send an email to us directly or connect with us. You can connect with us really quickly at granitetowersequitygroup.com. It's www.granitetowersequitygroup.com/contact us. We have a 506c fund open right now for a triple net lease fund, which has 3 car washes in it. It's our first fund where we're commercially raising. We can talk about it publicly. Everything else we've done privately. Again, a 506c, you do need to be an accredited investor. The value for these car washes is massive amounts of depreciation year one. You're going to have a cost segregation study completed with bonus depreciation. Year one will get you about 130 to 150% losses year one. So if you put 100 grand in, you're going to get between 130 to 150,000 of negative on your K1. It doesn't mean you lost, it means the deal has a negative K1, which can offset passive income. And then obviously the consistent cash flow of these triple net lease deals, meaning we don't have any expenses on our end. We just have to qualify the operator and the lease and make sure that we have a corporately backed healthy company. And then obviously, ideally, we get some cap rate compression moving forward based on where we are in the market cycle. Again, my name's Dan Brisse. Thank you for listening. We'll see you in a couple of weeks.